Hello and welcome to a new episode of Under 360 English. So this is the 7th episode of the series on fundamental analysis tutorial. Today we are going to analyze the balance sheet in depth and the key ratios that you can derive from a balance sheet. How well you can understand the calculations involved in a balance sheet. That's what we are going to discuss today. So stay tuned, keep watching. As we told in the previous episodes, we are using the Hindustan Unilever balance sheet to demonstrate the tutorials. So it's always advised you to download the Hindustan Unilever's annual report from either from the Hindustan Unilever website or from the BSE or NSE websites and keep it handy with you so that you can able to understand the discussions, the tutorial in a better way. So today's video will give you some much needed information about the company's performance and their financial standing. You can find the balance sheet over here, the Hindustan Unilever balance sheet, and now we are going to discuss about some of the important financial numbers, ratios and their calculations. So as you know, now there are plenty of financial ratios and calculations that we have discussed earlier. However, not all of them might be of use to you as an investor. So we will be looking at only the key ratios and financial numbers that can help you take better investment decisions. The first one is the current ratio. The current ratio, that's basically the liquidity ratio. That measures the company's ability to pay off its short-term debts and obligations. So which are typically due within 1 year or so. That's why it's called as current ratio. It tells you whether the company has enough current assets or liquid assets to repay the short-term dues. Mathematically, we can say that the current ratio is the ratio of current assets to that of current liabilities. Where you can find the current assets in the balance sheet, here you can find the current assets, and the current liabilities also you can find the balance sheet. So take the ratios of it, divide the current assets with the current liability numbers, you will get the current ratio. In the case of HUL, the total current assets comes approximately 11,908 crores, while the total current liabilities is 9,104 crores. So the current ratio is 11,908 divided by 9,104. So that gets 1.3. So a current ratio greater than 1, we have shown here, that shows that the company has the financial resources to remain solvent in the short-term time frame. Or as an investor, you should not select any companies for investment when its current ratio is less than 1. That's the theoretical aspect. But on the other hand, if company shows a lot of growth prospects, you can consider otherwise. Not just based on current ratio you can't take the investment decision, but current ratio is one of the most important ratio when considering the fundamental analysis. And the second one is return on equity, ROE. So this is one of the most widely ratios that we use in fundamental analysis. The return on equity that helps you to determine a company's ability to make profits using just the funds from its shareholders. So that gives you a fair idea of the returns of a company that generates for every 100 rupee invested by the shareholders. So in short, that expressed in percentage when you say. That means higher the return on equity, more efficient the company is at using the shareholders' funds to generate profits. So ROE mathematically can be found by the ratio of profit after tax to that of shareholders' equity, that you can express in percentage. That means PAT divided by shareholders' equity in percentage. So in the case of Hindustan Unilever, the shareholders' equity is 8,031 crores and PAT, profit after tax, is 6,738 crores. So 6,738 divided by 8,031. If you can express that in percentage, that gives the ROE. So that you will get as 83.9%. That means the company generated 83 rupee 90 paise on every 100 rupees invested by the shareholders. That's much efficient. The third ratio is ROA, return on assets. So the return on assets ratio, that gives you an idea about how efficient the company is at using its assets to earn revenue. A high return on asset indicates that the company is good at utilizing its assets to generate earnings. ROA is also denoted in percentage, and it is calculated as the ratio of net income to that of total average assets. That's in percentage. The total average assets that you can find by adding the total assets of the current year and total assets of the previous year, that divided by 2. In the balance sheet here you can find the previous year's total assets and the current year's total assets. You add it together and divide it by 2. In the case of this balance sheet, you can find that the average assets is 18,733.5 crores. If you take the net income from the P&L statement, you can find that the net income is 6,738 crores. So return on asset, that you can find it as 6,738 divided by 18,733. So you will get as 35.96%. The fourth ratio is return on capital employed, ROCE. This is a very popular profitability ratio generally used by all the long-term investors. This determines the company's profitability with respect to the overall capital employed by it. Unlike ROE, where only shareholders' funds are included, ROCE also takes into consideration a company's debt obligation. Hence, the higher the ROCE, the better the company's profitability. This ratio is also expressed in terms of percentages. So how you can calculate it mathematically? It's a ratio of EBIT. EBIT means earnings before interest and tax and overall capital employed. So EBIT divided by overall capital employed, that you can express that in percentage. Then you will get ROCE. How you can find the overall capital employed? You just deduct the current liabilities from the total asset. You will get the capital employed. And the fifth ratio is debt to equity ratio. So one of the most popular leverage ratio, that is debt to equity ratio, that determines the proportion of debt to that of the equity in a company. The debt to equity ratio greater than 1, that means the company has more debt than equity, while ratio less than 1, that means the equity portion is more than debt. But on the same time, if that's equal to 1 means both are equal. Mathematically, debt to equity ratio is total liabilities divided by total equity. Now you can find these values in the balance sheet on the company itself, as we have shown here. The total equity that has been put in a red box. Similarly, the total liabilities also given there. So in the case of HUL, the total liability or debt you can find it as 11,571 crores and equity is 8,031 crores. So divide 11,571 with 8,031, you will get as 1.44. The sixth ratio is debt to asset ratio. So similar to debt to equity ratio, this ratio also determines the proportion of debt to that of the assets of a company. This is a leverage ratio that gives you information on the percentage of assets of a company that are financed through debt. The lower the debt to asset ratio, that is better. Mathematically speaking, debt to asset ratio you can find it as total liabilities divided by total assets. That you can express that in percentage, that means multiply it with 100. In the case of HUL, you have already seen that where you can get the liabilities. The liabilities are 11,571 and the total asset is 19,602. So divide 11,571 by 19,602, express that in percentage, you will get as 59.02%. That is the debt to asset ratio. So the debt to asset ratio 59.02 means around 59.02% of the assets owned by HUL is financed through debt capital. The seventh ratio is equity multiplier. A variation of a debt to asset ratio. The equity multiplier determines the amount of assets that are funded by shareholders' equity. The lower the equity multiplier, that's better. Mathematically speaking, equity multiplier you can find it by dividing the total assets by the total equity. In the case of HUL, The total assets are 19,602 crores and total equity is 8,031 crores. So divide 19,602 crore with 8,031. You will get as 2.44. So what does it mean? This means that for every rupee of equity, HUL has 2 rupee 44 worth of assets. So that fair enough, good enough. The eighth ratio is fixed asset turnover. So it establishes a relationship between the operating income of a company and its fixed assets. Fixed asset turnover, that basically an indicator of efficiency and is used to determine how much sales a company generates using its fixed assets such as plant or equipment or machinery and the capital work in progress, CWIP. The higher the fixed assets turnover, that's better always. Mathematically speaking, fixed asset turnover is the ratio of revenue from sales divided by fixed assets. How you can find the fixed assets? Fixed asset, if you have some value for property or plant or equipment that add with capital work in progress, with the goodwill, that kind of thing and other intangible asset. If you sum it up, you will get the fixed asset. So in the case of HUL, from balance sheet you can find that the fixed asset is 5,569 crores. Ninth ratio is working capital turnover. Working capital turnover funds that the company requires to run its everyday operations. The ninth ratio is working capital turnover. Working capital turnover are the funds that a company requires to run its day-to-day operations. Okay. So the working capital turnover ratio basically gives us an understanding of just how much revenue a company makes for every rupee of working capital. A high working capital turnover, that's always good because it means that a company generates more revenue per rupee of working capital. How you can find this mathematically? It is the ratio of operating revenue divided by average working capital. Then how you can find the working capital? Working capital is nothing but the current assets minus current liabilities. So the average working capital, you can find it by adding the working capital of the current year and working capital of the previous year divided by 2. This you can find it from the balance sheet like as shown here. So from the calculation you can find that the working capital turnover of HUL is 13.32. That means HUL generates 13 rupee 32 paise of revenue for every rupee of working capital. That is a very good conversion rate. And the 10th ratio is inventory turnover ratio. This ratio determines the number of times a company has managed to sell and recoup or replenish its stock of finished goods. It is typically calculated for a specific time period. Mathematically speaking, inventory turnover ratio is the ratio of cost of goods sold to average inventory. Some companies may use their revenue from sales instead of cost of goods sold to calculate the inventory turnover ratio. So in that case, inventory turnover ratio will be revenue from sales divided by average inventory. In the case of HUL, it is revenue from sales only, and that you can find it from the revenue from operation. There you can find sale of goods. So what does it mean? So this means HUL has managed to sell and replace its entire stock of finished goods in approximately 15 times in an year. The 11th ratio is inventory number of days. So inventory number of days determines the time taken by a company to convert its inventory to cash through sales. The lower the value of inventory number of days means that a company is able to quickly sell its goods for cash, which effectively means that its goods are in demand. So you can calculate it using the formula inventory number of days equal to 365 divided by inventory turnover ratio. For in the case of HUL, that you can find it as 24.12. That means approximately 24 days for Hindustan Unilever to convert its inventory into cash. That's less than a month. The 12th ratio is accounts receivable turnover. The accounts receivable turnover is similar to that of the inventory turnover ratio. It determines the number of times a company collects cash from its debtors. A high the accounts receivable turnover is favorable since it means that a company collects cash frequently. Mathematically, the ratio can be calculated as the revenue from sales divided by average accounts receivables. Let's take a look on how HUL has performed in terms of accounts receivable turnover. So average accounts receivable is 1359.5 crores. How you can find it? Just average the trade receivables on the current year and the previous year. That means 1046 crores plus 1673 crores divided by 2. So accounts receivable turnover of HUL that you can find as 28.15. This indicates that HUL has collected cash from its debtors approximately 28 times in the year. This indicates that HUL has collected cash from its debtors approximately 28 times in that financial year. 13th ratio is the average collection period. The average collection period determines the time it takes for a company to collect cash from its debtors. The average collection period determines the time it takes for a company to collect cash from its debtors. The lower average collection period is favorable since it effectively means that the company is able to collect cash quickly. That means the collection is better. Mathematically, it can be calculated as 365 divided by accounts receivable turnover. In the case of HUL, the average collection period is 12.96. That means 365 divided by the previous thing that we have found as 28.15. That's account receivable turnover. We have found that the previous ratio. So this indicates that the company takes roughly 13 days to collect payments from its debtors. Well, that wraps up this episode on the ratios based on the balance sheet of a company. But this is certainly not the end of the discussion, because we have the cash flow statement to consider. What does that statement basically shows and how we can analyze it better, and what are the ratios associated with that cash flow statement. These are some of the things that we consider in the next episode. So keep watching, stay tuned for the next episode, and see you in the next episode. Till then, bye from Anup.